Welcome to the Way of Wealth. I'm Corey.
And I'm Lily,
Have you heard of Robert Kiyosaki?
the author of Rich Dad, Poor Dad? Of course.
He recently interviewed George Gammon on his show, discussing a topic called the private credit crisis. Kiyosaki said something exactly like 2008, just with a different name.
What does that mean?
In 2008, it was called the subprime crisis. Now in 2026, it's called the private credit crisis. But the essence is the same. Both are junk loans, lending to people who fundamentally can't pay back.
How big is this one?
The current private credit market size is conservatively estimated at $1.8 trillion, comparable to the 2008 subprime market's $1.3 trillion. But some estimates believe it's already reached $3.5 trillion.
Why such a big gap?
Because this market is extremely opaque. That's one of the core problems when you can't even determine market size. How do you assess risk?
How does it actually work? I don't really understand what private credit means.
Gammon gave a very vivid example in the interview. Suppose there's someone with a credit score of only 500, just out of prison, no job, going to a bank to borrow $500 million.
The bank obviously won't lend to him.
Right. But then a shadow bank appears, a private credit institution. They go to the bank and say, "We have a 780 credit score, Harvard and Yale graduates." So the bank lends them $500 million.
Then what?
Then these private credit institutions turn around and lend that $500 million to that guy with the 500 credit score, charging him 14% interest.
Will this person pay it back?
Of course not. He never planned to repay. But the private credit institution already got the bank's money risk, gets transferred layer by layer.
It really does sound like the 2008 subprime crisis.
Not just similar, even the numbers are close. Let's look at default rates. Official numbers say private credit default rates are 2 to 3%, doesn't look high.
But actually,
If you include soft defaults, meaning debt restructuring, payment extensions, paying interest with assets, the real default rate is closer to 5 to 8%.
8%?
Morgan Stanley even predicts that, due to AI's impact on the software industry, private credit default rates could reach 8%, and this number is still rising. January 2026 already hit 5.8%, an all-time high.
How much is the banking system exposed?
According to official Financial Stability Board data, banks' direct credit lines to private credit funds are $220 billion. But that's just direct exposure.
There's indirect too?
Commercial estimates suggest if you include indirect exposure like credit risk transfers, revolving credit, synthetic instruments total exposure could reach $270 billion to $500 billion.
Are there other risks?
Yes. Fed Governor Barr warned in May this year that private credit stress could trigger psychological contagion, leading to broader credit tightening.
What's psychological contagion?
Panic spreading. When investors see private credit funds start limiting redemptions, they worry they can't get their money back. So more people demand redemptions, creating a vicious cycle.
Are there signs of this now?
It's already started. In Q1 2026, redemption requests exploded from $1 billion in Q1 2025 to $14 billion. Major fund average share prices dropped 30%.
30%?
Right. BlackRock, Apollo, Ares, these major institutions have all started restricting redemptions. When you want your money back but are told not yet, what do you think?
I'd panic more.
That's psychological contagion. And this is just the beginning.
This reminds me of something. Corey, what did the Fed chairman say before the 2007 subprime crisis erupted?
Good memory. On March 28, 2007, Bernanke testified to Congress and said something that later became a historical joke.
What did he say?
He said, "At this juncture, the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained."
Then what?
18 months later, Lehman Brothers collapsed and the global financial crisis erupted. In May, Bernanke still said the financial system would absorb subprime losses without serious problems.
So now, in 2026, how does the mainstream assess the private credit crisis?
Goldman Sachs says, private credit stress is unlikely to trigger large-scale economic spillover alone.
Exactly like what Bernanke said back then.
Right. History doesn't repeat, but it rhymes. 2007 said contained. 2026 says unlikely to trigger a loan.
But what if it's not a loan? What if combined with other risks?
That's the key. Goldman itself admits if private credit stress combines with economic recession, Iran war, or software industry collapse, any two happening simultaneously, risks would surge dramatically.
All three risks exist now.
Exactly. The Iran war is already happening. The software industry faces AI disruption. Recession signals are everywhere. This isn't an isolated problem. It's a triple overlap.
So if private credit really collapses, how will it affect our stocks?
That's the key point we're discussing today. Private credit collapse first reaction is banks tightening credit.
Then what?
Credit crunch. Companies can't borrow money. Buybacks stop. We've discussed before that S&P 500 quarterly buybacks have exceeded $290 billion, over $1 trillion annually. This is the stock market's biggest buying force.
If buybacks stop, the market loses its biggest support.
Right. And retail investors' absolute amounts simply can't sustain current valuations. The S&P 500 P/E ratio already exceeds 25 times without corporate buybacks. Who's buying?
So people heavily invested in stocks are actually exposed to huge risk.
That's why we keep emphasizing don't put all your eggs in the paper asset basket. Stocks, bonds, these are all inside the financial system.
So how should we protect ourselves?
Before discussing that, I want to share warnings from two Fed insiders. The first is Richard Fisher, former president of the Dallas Federal Reserve Bank.
What did he say?
Fisher was a voting member of the Federal Open Market Committee during the 2008 financial crisis, personally participating in bailout decisions. After retiring in 2016, he said something on television.
What?
He said, "The Federal Reserve is a giant weapon that has no ammunition left."
That was said in 2016. What about now in 2026?
Fisher also frankly admitted that in 2009, the Fed pre-borrowed a massive bull market, aiming to create a wealth effect. He said, "I was part of it, personally participated in this decision."
Pre-borrowed? Meaning they used up future gains ahead of time?
Exactly. In 2016, he said the ammunition was gone. Now it's been another 10 years. What tools do you think the Fed still has?
Did anyone else say this too?
Yes. Donald Cohn, former Fed vice chairman. He served as vice chair from 2006 to 2010, was a core decision maker during the 2008 financial crisis, personally assisted Bernanke with the bailout.
What did he say?
Cohn said in 2018, "It is deeply worrying that policymakers may not have the tools to fight the next financial crisis." Cohn said,
Why no tools?
"Let's look at the numbers. In 2008, the federal funds rate was still at 5%. The Fed could cut rates dramatically. Now, in 2026, rates are only 3.5%, even less room to cut."
What about the balance sheet?
In 2008, the Fed's balance sheet was $900 billion. It could expand massively. Now, it already exceeds $8 trillion. No more room.
So when the next crisis comes, the Fed really can't save us.
And don't forget, federal debt already exceeds $38 trillion, over 100% of GDP. Net interest payments account for 14% of federal spending.
That number is staggering.
So when the private credit crisis erupts, the banking system collapses, credit tightens, corporate buybacks stop, the stock market crashes, and the Fed can't save us, what will our stocks become?
A piece of paper.
That's why we need to allocate to physical gold and silver. Not for short-term profits, but so that when the future environment becomes turbulent, your family's wealth and monetary purchasing power won't be diluted by fiat currency.
But why physical gold and silver?
MacLeod has a theory called the final settlement theory. Gold and silver are the only assets with no counterparty risk.
What's counterparty risk?
Stocks, your counterparty is the listed company. Bonds, your counterparty is the issuer. Bank deposits, your counterparty is the bank. All of these can go bankrupt.
But gold and silver won't.
Completely correct. Physical gold and silver in your hands have no counterparty, no default risk. When the entire financial system collapses, only what you can touch truly belongs to you.
If you can't touch it, you don't really own it.
That's our channel's core philosophy all along. Now back to the private credit crisis. Do you think history will repeat?
Bernanke said, contained. 18 months later, Lehman collapsed. Now Goldman says, unlikely to trigger a loan. How much time do we have?
Nobody knows. But we know that from 2007 to 2008, from warning to collapse, it only took 18 months.
So what should we do now?
Review your asset allocation. If you're heavily invested in stocks, you're putting your fate in corporate buybacks, in the Fed, in a bailout mechanism that's already out of ammunition.
But if we allocate to physical gold and silver,
You're taking fate into your own hands. The way of wealth isn't trying to create panic, but to remind listeners to deploy ahead.
waiting until the crisis comes is too late.
Exactly. In 2008, how many people only woke up the day Lehman collapsed? How many watched helplessly as their retirement accounts evaporated?
We don't want to be next.
That's why we're sharing this information today. Private credit market $1.8 trillion. Default rate 5.8%. Bank exposure $200 to $500 billion. Fed has no ammunition. These are all facts.
And the mainstream still says unlikely to trigger systemic risk.
Just like Bernanke's contained in 2007. History tells us when the mainstream says everything's fine, that's often when it's most dangerous.
What are physical gold and silver prices now?
Gold is currently around $4,700. Silver around $77. MacLeod believes that as a strategic resource, silver's value is between $150 and $200.
What if you add the monetary preservation property?
Could reach over $300 because silver's paper to physical leverage is 200 to 400 to 1. Once there's a run, prices will jump non-linearly.
What does 200 to 400 to 1 mean?
It means paper silver circulating in the market is 200 to 400 times physical silver. When everyone demands physical delivery and there's not enough physical, prices will skyrocket.
What's the connection to the private credit crisis?
Both are leverage. Private credit uses good credit to leverage bad credit. Paper silver uses paper to leverage physical. When leverage breaks, truth emerges.
So allocating now isn't too late.
But we must remember one principle. Allocating to physical gold and silver isn't for short-term profit, but to protect your family's wealth when the future environment becomes turbulent.
This is wealth insurance, not a speculative tool.
Right. When the private credit crisis erupts, when the banking system collapses, when the stock market crashes, when the Fed can't save us, the physical gold and silver in your hands is your last line of defense.
If you can't touch it, you don't really own it.
This phrase will become increasingly important in the days ahead. We've talked about a lot today. What are your thoughts?
I think the most shocking part is the warnings from Fed insiders. Fisher says no ammunition left. Cohn says no tools left. These are people who personally participated in the 2008 bailout.
They know better than anyone where the Fed's limits are.
And Bernanke's contained historical lesson is really ironic.
So we must learn from history and not repeat mistakes. Listeners, if you've heard this far, please seriously think about your asset allocation.
Are you heavily invested in stocks? Or have you already allocated to physical gold and silver?
Are you putting your fate in corporate buybacks and the Fed, or taking it into your own hands?
This isn't fear-mongering, this is history's lesson.
All right, that's it for today's show. Bye.
Bye.